what's going on. I mean, the last time we talked about it, we were already at the start of this bond bear market, as they were calling it. We've seen fits and starts already, 2.6% right now. Are we in no man's land?
I think we're not at the level now or the pace of yield increases that really is a challenge for stock markets. Obviously, volatility in stock markets has been incredibly low for an extended period. I mean, certainly through all of last year. I really think, for people to get real jitters in terms of, the knock-on effect of stock markets, we probably need to get certainly above 2.75, but probably even above 3% before people say, oh, actually, we are in a bear market. I know we've had some people saying 2.63 very precisely is the number. I think it's more of a range. If we break above 3%, that 35-year bull market for bonds does appear to be over.
What's driving this, do you think? I mean, this looming government shutdown, I don't think really is. It's just kind of one of those known unknowns, right? Is it really just? And we saw this chips auction. We're seeing quite a bit of demand here when it comes to inflation protection. Is that kind of the bet here that inflation is going to come back in a big way this year? I'm
not sure it's in a big way, but I mean, if you look at it from two perspectives, you say, OK, from a macroeconomic perspective, we've gone from a Goldilocks environment of strengthening growth and still very low inflation. People are now saying growth is going to remain strong, but maybe inflation will start ticking higher. And the second part is, obviously, with short-term interest rates going up, leverage bond positions are becoming more challenged.
Right.
So that means that the game over the last, certainly post-crisis, where basically you borrowed and invested in any bond you could find, that's getting trickier now, especially in the investment grade, because shorter-term yields are going higher and longer-term yields aren't moving up that much. So that spread is narrowing. And obviously that could lead to a tipping point that pushes bond yields much higher.